Okay.
Hi everyone. Well, thanks for joining this webinar on venture debt. We'll wait probably a minute or so before we get right into it, just to give people who are a little slow a bit of time to join. But whilst we're waiting for them, firstly, thanks for joining. It's great to have everyone joining both online live and also obviously listening to the recording. Venture debt is super important and growing part of the capital raising ecosystem. So very excited to have James McGrath from One Ventures, principal of One Ventures, who is going to be talking about about venture debt, really kind of venture debt 101, explaining the basics, and then going into a bunch of detail around the sort of things that you want to look out for when considering venture debt, the sorts of opportunities that make sense for founders and for startup executives looking at venture debt, and then we'll take questions. So I really want to mention before we get right into it, if you have questions, make sure you type them into the chat function in GoToWebinar, and we'll get to questions around 20 minutes into this presentation. Obviously, questions is obviously one of the better parts of any sort of presentation like this. So make sure that you put in any questions you've got, and we'll try and get to as many of them as we can. All right. So James, thank you very much for joining. You're obviously pretty well known in the venture debt space in Australia. Currently, actually in Mexico. So thank you for taking the time to join on your holiday. Do you want to give us a quick intro to your background, particularly in the venture debt space, and then once we've done that, we'll get into the guts of the presentation.
Yeah, sure. So a bit about me. So hey everybody. So James McGrath here. I've been at One Ventures 6 years. Before that, I was doing investment banking at Citibank, Credit Suisse, and a firm called LA Capital, which is a mid-market M&A firm here. Joined One Ventures, helped launch their Series A/B fund and divest that. And then we looked at the Australian ecosystem. We thought, we don't want to just do another fund like everyone else is doing. We want to do something unique. And we had seen some US venture debt providers flying in and doing something, but no one dedicated. So we set out to our investors, pitched the fund, raised 75 mil, deployed that whole fund. It's gone really well. We've had some great loan returns and warrant returns, and now are raising a second fund, which will be about 150 mil. Yeah, that's it. And in One Ventures, I'll just do a little bit basics too. Look, we're a diversified venture group, so we do venture capital, private equity, venture debt, and also healthcare investing. We've got about 500 mil under management, maybe 600 mil now under management, and about 25 people, mostly based in Sydney. Probably our best known company is Employment Hero, where we're the first investor, and that's gone from, that was probably doing a couple 100K when we invested, and now it's approaching 100 million. Huge success. And then some other ones include ShipIt, eClub, HomeTime, Hivery, and many more if you recognize some of those names.
Great. All right. Well, thanks for that, James. It's a great intro. So look, we obviously do a lot of these webinars. The startup space, there's so much information that founders, CFOs, executives, and people thinking about getting into the space need to know. So we do a lot of these webinars. A lot of them focused on capital raising. Now, the reality is, when most people think capital raise, I'm not sure what they're thinking, but certainly what people end up doing is equity capital raises, right? And that's everything from a seed round, to Series A and beyond. Obviously, friends and family, venture capital providers, late stage growth, PE, or whatnot. At the end of the day, all of those sorts of deals are, involve selling equity in your business, and that's what people kind of tend to do, certainly in Australia. So venture debt's something that's different. It's in Australia, fair to say, emerging, and so it's an interesting thing for us to be talking about, because particularly with the current sort of capital raising environment, probably something that's going to become bigger and bigger in Australia. So do you want to give us just a quick rundown of what is venture debt and how does it differ to I guess venture capital?
Yeah, sure. Yeah, look, definitely the whole startup mindset is around venture capital equity. I think venture debt, it even sounds a bit of a weird term because they really want to finish the word venture capital. But venture debt started in Silicon Valley in the 80s when startups had to buy servers and they didn't want to constantly raising equity to buy, like hardware that they needed to run the businesses off. So businesses then started saying, we'll lend you some money. So maybe I'll go into what venture debt is. So venture debt is a senior loan. So for the lawyer types there, it's the highest ranking loan to businesses, and we take an interest rate on that loan of normally 10, 11, 12% kind of standard rates now. And what makes it venture debt is we also request from the company a small warrant, which gives us some kicker if there's a huge explosion in the equity price. And by a warrant, I mean an option to purchase shares, usually at the current price. So to give an example, let's say you're a SaaS company, you're doing 3 million in revenue, you raise, let's say 1 million in venture debt, you repay it over 3 years, amortizes equally over those 3 years, so 36 equal payments. 11% interest would be the kind of standard for us now. And then for $1 million, we would request 20% warrant coverage, or that would be 200K in options in the company. So the advantage for the business of doing this structure as opposed to equity is if the equity goes very well, it's been much cheaper. If you sell equity at $1 million and your company sells for 100, the investor is making 100x, roundabout, right? If you took $1 million from us and then the valuation was 200, we probably make 1.5, 1.6x so of that million. So it's far more advantageous for the startup founder if things go well. Now, people always say, well, people feel sensitive to debt. I understand, like even in myself, the idea of borrowing too much, doesn't sound like a good idea. And I would say to businesses, we would never lend. Like if you think you're risky, we'll think you're very risky. We are kind of only really available to later stage businesses that have very good backers, really great profiles, and we'll lend them a small amount. It doesn't replace venture capital because venture capital could be 80% of the funding, but we play a small amount or like an in-between round role just to kind of facilitate the overall funding, which is generally equity.
Yeah, and I think this is something that a lot of startup founders don't think about and probably should, and it's the cost of capital. When you think about the most expensive capital you'll ever raise is equity, and look, at the end of the day, if you can add some debt into the mix and you're the right type of business to add some debt into the mix, it means your overall cost of capital is reduced, and that's only to the benefit generally of the existing shareholders, at least, which is often the founders and the earlier stage investors. So I think it's fair to say you'll see most Australian VCs, the best VCs that certainly we work with will certainly encourage the founders that they've invested in to raise venture debt if it's appropriate as part of a mix, because often it's they're an existing shareholder. It's going to be to their benefit as well to add some debt into the mix. So I think that's a great sort of introduction. A couple of things that were interesting that worth picking up on. The first is, you mentioned, it seems there's really two scenarios in which you'll do a venture debt round broadly. The first is when there's an equity round that's happening and you'll do some debt as part of that round, or at the same time, or roughly the same time as that round. And that's really the reducing the overall cost of capital kind of concept. And the other you mentioned is sort of bridging finance to help us, a startup moving between equity rounds, and I thought that was interesting. Do you want to give us a bit more insight into how that works and the circumstances?
Yeah, so there's two cases. First case is alongside the round, you want to raise 10 million, you do 7 million in equity and 3 million in debt. It just kind of tops up the round and reduces the dilution instead of taking it for the founder, a 20% dilution hit, you take a 16, 17, and you feel favorable about that. The case that I think is most appropriate now in the current market is in between rounds. Because venture debt, because it's a loan, there isn't a loan with options. There isn't a repricing of the company. And a lot of companies who raised in late 2020, 21, early 22, raised at very high multiples, like really astronomical multiples that probably didn't exist since 2001. So let's say you raised at 20 times revenue at a 200 mil valuation, things went really well. You're now looking, you've grown 30, 40%, you're a bit bigger, but multiples are down to 4x, they're down so much. And you need money, you're burning money, you can't cut your burn fast enough, or go to break even, or you don't want to. You can't really do an equity round because it's a down round, and that has negative signals for employees whose options are no longer worth anything, for reorganizing the board, huge dilution for the founders. So that's where a lot of companies are coming to us in the last few months and even weeks, especially looking to raise a venture debt, an intermediate round that gives you 6 months more runway, allows you to get to that next geographical milestone, new feature, new product, new revenue point, just all these kind of valuation inflection points, break even or lower burn, or just transition through this kind of crazy market time and then raise then. So I think most people get venture debt as a kind of bridge round financing. So okay. We don't think of ourselves as a bridge round because traditionally a bridge round is meant to be like, we give you $3 million, you pay us back in the next round. We actually stay with the company the whole way. So that's why it's called.
Yeah. Okay. Interesting. All right. So let's kind of dig a bit deeper into the average kind of structure. Yeah. Well, obviously every deal is different, but the sort of terms that a founder can be kind of expecting broadly, interest rate, fees, the warrant and how that works. Like how does that all fit together?
Yeah, so let's say typical loan for a $3 million SaaS company would be $1 million drawn at the start, repaid in 36 monthly payments of interest rate 11%. And then, as we said, like warrants of, it's in that 10 to 20% range, so 100 or 200K warrants. The warrants aren't worth anything until the company exits, so we're completely on risk for that. Yeah, and that's a typical structure. To be honest, one thing about venture debt is different than venture capital is we can really customize the loan to exactly what the company needs. They can draw down some now, some in the future. Yep. We can capitalize some of the interest sometimes or not. There's a lot of, we can do the warrants at a future strike price. We have a lot of, it's a structured product, so we have a lot of flexibility.
And so what are the, obviously, there's probably a lot of founders on this webinar thinking that sounds great. Can I have some? So, how obviously you're not lending to everyone. How do you work out what type of a startup is, I guess, credit worthy? Because ultimately it's a credit product, right?
Yeah. So we have a minimum criteria of 2 million revenue. We really like to see 3. We want to see good investors. I think venture debt is largely lending against your investors, and that's for a lot of startup funders. Like, why take on a bigger venture fund or a smaller venture fund when you're assessing those 2 options? I mean, in terms of accessing other capital, in terms of accessing venture debt, a bigger fund is key to us. And then aside from that, we just look at all the things that a normal venture fund looks at. It's a good management team, good economics, opportunities there, like all the typical things, but just with probably an additional emphasis on the size of the venture backer and runway. I think we probably want to see the business has 6 months runway. There is this a bit of a moral hazard where people will come to us like absolute, like if we see 1 month's runway, we're thinking probably with the last port of call and probably not a very good credit opportunity.
Yeah. Okay. So So I guess to kind of summarize, you're looking for businesses that are doing, you know, was it 3 mil of revenue that have generally raised from, you know, sort of reasonably well-known, you know, VC, and you know, beyond that, it really kind of depends on the individual businesses, but there's some of the criteria. Okay, so it's not you're not raising venture debt when you're kind of super early stage, put it that way.
Yeah, exactly. It's probably Series B, Series C.
Okay, all right. So beyond that, I think you know, what would be interesting. Obviously, we are you know, LegalVision is a law firm, and a lot of the people joining the webinar will be, you know, interested in, you know, how do you, you know, what's the kind of legal side of things. So in terms of documentation, you know, security, all that, how does that sort of work generally?
Yeah. So generally, you know, in terms of overall process, both sides would have legal advice. We use LegalVision often, but we've also had LegalVision on the other side as well. There's 3 key documents. There's a facility agreement, which outlines the terms of the loan. There's an option agreement, which outlines the terms of the option, and a security agreement, which grants us security of the business. So it is quite straightforward, and we normally find legal negotiations only take about 1 or 2 turns on most deals, on most standard deals, but then you also have the anomaly standard that just keep going round and round.
Yeah.
Sure. So the legal process is around 2 to 4 weeks.
Yep. Okay. So really, it's one of those, you know, again, to set alongside other forms of capital. It's a form of capital that, like, once you've kind of made a call that, you know, you're happy, yeah, you're gonna, you know, you've got the term sheet sorted out. Actually documenting the deal and doing the deal is pretty quick. Similar, I guess, in some ways to, you know, doing a deal, you know, an equity deal with, you know, an Airtree, a Blackbird, or whatever, where, you know, there's a kind of set term sheet, a set of standard documents. And again, generally, it's certainly you know, C and Series A, those sort of deals can be done pretty quickly. Whereas if you're dealing with a, you know, well, sometimes it's a US VC or whatnot, it can often be a lot more drawn out, complicated to get the deal done, which is something that I think is worth everyone considering when you're thinking about your, you know, potential investors. You know, you want to be working with people, you know, if possible, that can kind of do a deal quickly and do it relatively simply. I think that there's a lot of value in that. And certainly,
I would say the venture debt side is, in terms of credit assessment, because it's more of a, does it meet a criteria, you know, and, you know, it's more like, do we hope that the equity investment will go well, as do we need the equity investment to be a 10x? So yeah, because it's a lower bar, I would say our credit, like our approval process, is much quicker. Normally after meeting a company, we can give a term sheet within 2 weeks, sometimes within 1 week. Yeah. And then the legal process is much quicker too. So venture debt is much faster, but you don't get as much money.
Yeah, no, for sure. Yeah, that sort of makes sense. So I guess, you know, just a quick reminder to everyone, if you've got questions, we'll move to questions in a few minutes. So make sure that you submit them and we'll try and get to them. So, you know, a couple of questions I sort of have. Obviously, you've been in the space for quite a while now. What have you seen over, you know, there was the whole kind of COVID sort of, you know, there was a month or two where everyone's kind of going, it's going to be terrible. Then it went great, and now we're back to things are terrible. What happens in the venture debt space during those kind of
that's a good question. So first, kind of up and down cycle for me. Look, when equity went basically dirt cheap in 2021, we would give term sheets to people that were okay businesses, and here's, you know, $3 million venture debt, you know, it's good terms, and people are like, I just raised 30 million out of 300 mil foul. Like, this is just irrelevant, you know. And we have that a lot. There's a couple of players in Australia, and, you know, we have a good reputation. Probably take a little bit more than our market share, but there's probably like we don't really lose that many deals to other competitors. What we really lose them is to the equity option, right? And the equity option became basically free for a lot of people. Now we're in just like this crash of the multiples. It has just gone so much that if you're a company that was valued at 100 mil or 200 mil, and you're burning an amount where you need to raise 30, I don't know, say 20 mil, and your valuation now, according to public multiples, is 50. It's basically impossible for you to raise what you actually need to raise. So venture debt, which is, you can think of the cost of equity as kind of a linear graph that is determined by entry and exit price, right? And venture debt is a cash cost. There's a warrant gives a bit of a skew, but it's kind of, there's a fixed cash cost with a bit of a skew to the warrant. Like the equation has just shifted so much, where venture debt is just so much cheaper than raising 30% of your company. Basically, I think, and even aside from the companies we deal with, every single startup, Series B and onwards, is going to raise venture debt, because it's just a fact. Like the multiple compression just is probably 80% multiple compression. It's so stark that they can't raise equity. It's impossible. They're going to do venture debt. They're going to do an internal con note. Then they're going to try for a flat round. If they raise during those bubble times.
Yeah. Okay. Interesting. Unless you're one of the really best.
The really best, also the really best before though. Like if you're the really best, you raised it like 40 times revenue before, right? So in a way, you're even.
Or you're growing quick enough that you can catch the multiple up if you're growing quick enough and you're doing super well. But again, it'll be interesting to see.
Growing 200-300% a year. But yeah, it's true.
Well, it'll be interesting to see how it all washes out. So look, that's great. Look, I think we should move to questions. We've got a bunch of great questions here that really good. So look, the first one is, this is kind of a basic one, but good to set the scene. How do I prepare for venture debt? And I assume that, it's that, if I'm running my company, how do I set myself up, to be in a position to raise venture debt? I mean.
Yeah, well, thanks for the question, Oscar. It's a pretty mature question. So look, I think it's not as much as the venture capital. I think sometimes people really spend, I think, because I'm on probably six boards, too much time, like spending months getting all their ducks, everything so in a row, and speaking to us, right? Well, they tell us that's what they did before speaking. Venture debt, I think, probably get a third as you would get prepared for venture capital. So we're really looking much more at the accounting and what we say to companies is your last pitch deck, don't create us a new one. Your numbers and an hour meeting, and we can determine from that, like an 80% go. Don't spend.
Do you require on the accounts? Do you require audited accounts?
No. So we don't require audited accounts, and to be honest, in Australian startups, it's pretty rare.
Yeah. Well, I mean, you get to a certain revenue number, you have to, but that's a good point. All right. Another one. Let's run through these kind of quickly because there's a lot of them. And how do I deal with repayment and default?
Yeah, everyone always thinks about that. So we have never put a company into default. And our partner, Viola, who is Israel's oldest venture debt fund, I think they've done 100 transactions, has never put anyone into default. What happens is we just sit down and have a conversation. You can't repay, like, why not? Okay, because runway's getting short, because then we sit down with the CEO and with the board and say, what is the way out? Because there's actually nothing for us to take. I mean, that's different than most. There's a bunch of laptops and some, like some sticky notes on a wall and some chairs. Like, there's just nothing for us to sell. So you really sit down and you work out a solution together. And the solution often looks like a bridge funding from the equity investors to the company to a sale, if that's the way they want to go, or if they want to cut down the team 60% and try again in a different way. But it's really an ongoing conversation.
So that's sort of the default side of things. The repayment side of things, I mean, I think probably worth mentioning that. I mean, how many of your venture debt kind of loans kind of end up repaying along the schedule as opposed to, refinancing, or they're bought out by VC in the next round, or whatever it is?
I would say almost none look like almost none finish normally, but not always in a bad way. So we give you a schedule. It's like, these are your 36 payments that you owe us at this date, and it's for the accounts when they process it. It's just along the way, somebody raises a big round. They're like, can we repay early? Can we repay late? Guys, things aren't going well. Can we delay payments? It's just always an amendment. We sit down, have a discussion, we reissue like a new table, and that sits with the accounts team. So we don't have, one thing that we do that others don't do, which I really push for when we set the fund, is no additional reporting, right? So some firms ask for this is my monthly, every month I have paid you this amount, and as opposed to, concurring with these covenants and so forth, we just say, look, here's paper, accounts pays us, we listen in on the board, that's all we want.
Yeah. No, good. Let's keep moving. How can we use startup? I assume venture debt funding to fund advertising and product development, and if so, what sort of involvement and securities do lenders need?
Yeah, so there is revenue-based financing, which is like an IRR of 20% or more. It's a bit more expensive and a bit earlier, and I think they do target. They do ring fence their capital through using the platforms just for marketing. But for us,
So sorry, on that, last week we actually did a webinar with Dan Peters, the Australian CEO of Clearco.
Yeah.
If you're interested in that, and it's more e-commerce businesses that are just looking to kind of fund AdWords spend effectively, and other sorts of marketing spend. If you're interested in that, I encourage you to get in touch, and you can probably get the webinar on our website and listen to that, because that's specifically targeted to kind of e-commerce business wanting to fund advertising. But anyway, go on, James.
Yeah, so look, there are people who do that. All our capital is for general purpose use. Most of our capital general purpose use. So up to you to determine how to spend it.
And if you're a startup, like product development and advertising, probably two of the main things you're going to be investing in, right? So no, it's good. Can we get credit for a pool of assets used as security, for example, real estate?
Yeah, I mean,
just in terms of that question, yeah.
Well, look, not real estate, because I think real estate financing is dirt cheap. You can draw down a mortgage for like 3%. So, I mean, we're totally happy to lend against real estate, but it wouldn't be worth it for you. But we have done loans against bikes, for Zumo, and we have done loans against a loan book for Harmony, which is a listed online lender. So we do lend against assets. Yeah.
I think the main point is for people, that one of the benefits, or the key benefits of venture debt, and this is by the way, venture debt coming from a reputable venture debt fund, not venture debt from your uncle, is that the lender is getting security, but a GSA, security over the assets of the company. There's no personal guarantee. They're not taking security over your house or anything like that, and so it's it's the sort of, and that's why it's more expensive than borrowing against your house. So I think that's important to understand the value of that. That's incredibly valuable. Never sign a personal guarantee as a founder. It's not something you want to be doing, and venture debt allows you to not do that. And so I think that's something worth mentioning.
When we came to market, we did a few deals where we literally just refinanced people's personal guaranteed loans. It's a higher rate, but then some of the directors even were guaranteed who aren't even directly involved, not even like the main founder, just like a guy who put $100K in at the start.
Yeah. Well, this is actually the next question. As for security position, is it an all PAP over the company, or are the personal guarantees directors? So so there's no personal guarantees for directors, and it's generally a GSA, it's a general security agreement. So it's taking it's taking security over all the assets of the company, and that is registered on the PPSR. So those of you interested in the details of it, it's a good one. Is venture debt funding available for a structured buyout? I assume that's probably some kind of share buyback of existing shareholders.
I think a structured. Well, I'll just say, if you're buying it, like if you're going to buy a company, can you take venture debt to buy the company? Yes, if the company is creditworthy, then we have explored working with private equity firms to help them buy a company. And also, to Lachlan's point, if the business is large enough to take on venture debt, we could buy back shares from we could help the company buy back, let's say, founder or exiting founder shares at a certain price. And we've explored that too. But I find generally, the more complex the deals, like the less likely they are to close. And I have found a lot of those deals we explore, but they don't close.
Yeah, if you look, we see that a bit. It's obviously an issue in the startup space. A co-founder leaving, having a bunch of shares and not contributing, and if you haven't kind of had co-founder vesting in particular, that can be an issue. The challenge, I think, is this: if you're thinking about that sort of thing, and buying them back or whatever. If the startup's really successful, growing super strongly, raised large amounts of capital, high valuation, so on and so forth, then the founder who's left and who's got, I don't know, say 10% of the equities, not going to want to sell for a price that would enable you to raise like the sort of venture debt that you could raise. Just hard to get the structure to work. So, often what you're better off doing, if you could raise some venture debt in VC or whatever, is raise more, grow the company more. Don't worry about the fact that someone is going to get an outsized return they maybe don't deserve. At the end of the day, that's life. You move on. You should be focused on the company. The reverse of that is the business is really not successful at all, and you want to get rid of a co-founder. In that situation, why would VC, venture debt provider, want to be investing or lending to a business that's really not very successful? So in both those situations, it's
I would say to people out there, if they're considering that, look, don't spin your wheels on it, because you'll probably burn a ton of time and some legal costs, and it won't work out. So maybe I would just be word of caution. I haven't seen really any of those work out, and I've heard people talk about maybe we should do this a bunch of times.
Yeah. All right, let's keep moving. As a startup about to launch subscriptions, I presume that's maybe a SaaS startup. At what point can we look at the loan option, so venture debt over venture capital or equity capital, to retain more ownership of our business? What level of sales or profit or years in business can we start looking at venture debt?
Look, I think venture debt is probably going to be 2 or 3 million, but then there's revenue-based financiers who start early, and I would start really early, because you can kind of build up a bit of an informal credit history and build your business around a little bit, paying down, and even internally become comfortable with debt. That valuations were so high that you didn't really have to worry about dilution that much, before. But where they are now, like it really makes a big difference. I think there's an example of Dropbox and Box, and one used venture debt along the way, like 4 or 5 times, one didn't, and the ownership difference was like 3 and 20. It really can make a big difference.
Yeah, for sure. Yeah, I mean, look, on that, so it's probably the message then, just to summarize, is if you go to like a Clearco, you're getting 10K or something, 20K, 30K, whatever, early on. You build up the business, you scale. Then you get to the stage where maybe you start looking at venture debt, venture capital, and the same sort of deal. Are there facilities, tools you have available for early stage startups sub 2 mil? I think we've answered that. Basically, not necessarily for a One Ventures.
And by the way, our minimum check is 500K. I didn't say that.
Oh, sorry, what?
Our minimum check is 500K.
Minimum check's 500K, but you're still looking at kind of 2 to 3 mil of revenue. Yeah. Is there tension between equity investors, I guess, and debt investors, because debt takes preference or is higher up in the waterfall?
Yes, and at different points it's different. So at the investment point, generally the equity investors, they are diluted by a new round, but they're also putting money in. And the last few years they have this big fund, they want to deploy it in your company. So they don't really want you to raise venture debt, because they want to put money in, and that's your dilution if you're the founder in this case. So there's a bit of tension where I think often the founder wants venture debt. Well, he knows that he should want it, but he's somewhat still guided by the venture investor. And so there's a tension there. Once you're in, to be honest, we know all the venture capital investors really well, and most of them, it's just actually, they really appreciate us having there, but us being there, because we kind of think the same, and often we can play the bad guy in terms of like, let's not spend too much money. I mean, we don't really do that, but they can kind of speak to us in that way. And then is there a tension at the back end? Generally, no. Like, we have some companies now going through some pretty tough times, and it's still largely, how can we all work on this together? You know, we all kind of see things the same way. I think it helps that One Ventures does venture investing as well, and I used to do venture investing well, so kind of they see us as a peer rather than an enemy.
I think, you know,
at least a big one.
Yeah, at least in my experience, you know, in terms of advising startups over the years, the one area that can be tension with existing shareholders is if you've got sort of angel investors who are not that sophisticated, don't actually know much about, you know, venture debt, don't really understand the concept of the warrant and how the warrant works. That, you know, there's an education piece there, I think, that is important for the founders to go through with maybe their less sophisticated early stage angel investors, because, you know, if you need to get everyone on board. I mean, you know, it depends on the shell's going, but it's best to have all of your stakeholders, shareholders on board when you're raising a new round, and particularly bringing in venture debt. You know, you want to have everyone on board and in agreement and so on and so forth. So that's important. One thing worth mentioning there, in the GoToWebinar, we have a venture debt handbook and startup capital raising handbook. Both of them give a lot of information about how venture debt works, how a deal works, so on and so forth. So if you have, you know, existing angels that, you know, need to understand the concept, then that's a very good place to start sending that, you know. All right, let's, can we get venture debt / finance or venture capital to commercialize patented ideas like medical devices, space research products?
Venture debt, we need to see a couple more revenues, so I doubt that a patented idea research has it. I think that's venture capital stage still.
Yeah, I think that's the important thing for people to kind of you know, understand, is that equity is more dilutive, but is riskier capital. So they're looking for a much higher kind of 10x return. So they'll invest earlier stage on risky stuff. Debt comes in kind of, you know, in between. So it's venture debt still taking risk, but at the end of the day, you're looking for a much lower IRR, and then, well, not necessarily, but you're looking for a lower return on each individual deal, and so you know, you'll lend less, you'll take security and all of that. I think it's important to understand that. All right, this is a long one. So it's a scenario. I have a project that involves two fairly significant assets. One's 4 million, one's 1.8 million. We're past the design phase using our personal capital. I spent about 100K of the personal capital. They need funds to finish the final engineering and commence ordering and build. And the question is, can we secure against the asset? Traditional finance has been difficult as it's a new engineered product. Also, the asset may be subject to R&D rebates. Can this be built in? Yeah, look, I think I'll answer that one. It doesn't sound like the sort of investment, again, to venture debt providers will lend to businesses that are generating revenue. And that's 2 to 3 mil in the case of One Ventures. There's other providers that'll lend potentially at less revenue. You know, revenue-based finance at a much less revenue, but
and also R&D financing maybe for that person.
R&D financing is one option. So for R&D financing, you know, great. So if you're going to be able to claim R&D cash back on R&D, and you know that you'll be able to get that, you know, once you submit your application, which is I think in at the end of the financial year. There are funders out there who will fund against your R&D application. So they'll give you, I don't know, 70% of what you would get, and they're effectively financing the difference. So that's actually a good piece of advice from James there. An R&D funder could be an option. All right, we're sort of coming to the end of the allotted time. And we've got through most of the questions. Look, I think it's been a super useful discussion. I think to summarize, a couple of important things for everyone to remember. Firstly, venture debt can be a great addition to your kind of cap table, and I guess the cash that you're raising it really does reduce your dilution and therefore decrease your overall cost of capital. But secondly, it's only suitable for certain types of businesses. You need to be generating 2 to 3 mil of revenue, and if you're not, it's not worth going to talk to venture debt provider about a deal right now. It could be something that happens later, but it's worth bearing in mind that there's a reason that venture debt providers are investing in businesses that are generating revenue. It's because it's debt, it's not equity. In terms of if you are suitable for venture debt investment, and you talk to someone like James or any of James's competitors, and you get a term sheet, these deals can be done pretty quickly. So that's something to bear in mind in terms of how you're thinking about, cash burn, where we're at, all that sort of stuff. These
I would add, Lachlan, the time to speak to us is about runway of maybe 6 to 9 months. Any later, and it's about a red flag for us.
Great. And look, lastly, in the current environment, venture debt is probably, I think anyone in the space thinks that it's going to become a more prominent part of the startup capital raising landscape. It's been growing in prominence over the last 2-3 years, certainly, but it'll probably be even more prominent for the reasons that James has listed. So, James, did you have any kind of final messages for the attendees?
Yeah, I think we launched the fund because we think it's a great product for our portfolio companies, and I really think that don't get caught up in I want to announce a big round, a big amount of money raised. Think about the dilution, and don't think even just this round's dilution, but what about if you take 5 more hits of that size, and even if venture debt's only saving you from 20 to 17% dilution, it adds up. And my friends who started companies into venture debt or different loan products along the way, and they hold more of their company now, they really thank me for giving them that advice the whole way through. And we do it with a lot of companies on the equity side, so we do it with that.
All right, great. Well, look, thanks for joining us, James. Really appreciate it. For those of you listening, if you need any help on the legal side of things, LegalVision probably does more venture debt deals, both for lenders and companies than any law firm in Australia. So we're super happy to help you. If you need advice, you need help, you just need a chat, always happy to help. Look, have a great day, everyone, and thanks again for joining.
Thanks.